Hello and welcome to The Bottom Line on TVP World. This is where we unpack some of the main business and economic stories of the day. I'm your host, Marie Cato. It's that time of year when first quarter data is emerging and we're beginning to get an idea of how economies are faring after a rather intense start to 2025. Today, Hungary and the Czech Republic have announced their results with a 0.2% contraction for Hungary and a 0.5% growth for the Czech Republic. Let's go to Jan Kennedy, who tells us more about today's numbers.
After last year's recession, Hungary's economy was expected to rebound strongly in 2025, according to Prime Minister Viktor Orbán. However, the final day of April brought troubling news. The economy contracted by 0.2% quarter-on-quarter and remained flat year-on-year, hit by what many are calling a perfect storm.
Hungarian economy losing confidence of international investor, worsening ratings of its debt, public debt, because of quite huge deficits, motivated partly by the elections coming next year that are pushing Orbán's government to spend even more than before.
On top of that, the Hungarian Statistics Office blamed German industry woes for the slump. The country that is the top destination for Hungarian exports, with a 25% share of the total. In contrast, the Czech Republic has shown resilience. It managed to overcome external shocks, expanding by 0.5% quarter-on-quarter and by an impressive 2% on an annual basis, helped by a healthy domestic economy.
Last year, Czech Republic posted a historical record. Is a record the highest trade surplus on record. Household consumption also has been rising in Czech Republic because of the decline in inflation and because of quite solid growth of real wages.
Following the weak economic performance, Budapest has revised its 2025 growth forecast down to 2.5%. Yet many experts see this as overly optimistic. If new US tariffs are introduced, the outlook could deteriorate further. In fact, the impact of such tariffs could be severe, potentially costing Hungary up to $11 billion.
It will be very complicated for Budapest's government to get the growth over 2% it is aiming on. And because of this, I think it will be quite difficult for it to really have economy on its side with coming elections, because there is also for next year a strong downward risk for the forecast.
Meanwhile, Poland, Central and Eastern Europe's largest economy, is more reliant on domestic consumption and won't be as exposed to the tariff blows.
Within the region, we see Slovakia, Hungary and Czechia as most exposed to the direct negative impact of tariffs, and then the indirect impact will affect the whole region. Poland, in these terms, because it's relatively closed economy compared to Slovakia, Hungary or Czechia.
However, in his latest interview with TVP World, Poland's finance minister was more optimistic, claiming that the country's economy will expand by 3.9%.
So yesterday we explored interest rates in Hungary, which unsurprisingly remain at 6.5%. Today we carry on examining the economic situation in Hungary, but expand on this by looking at the freshly released GDP data for the first quarter of the year, along with the Czech Republic. I'm pleased to welcome the Chief Economist of VeloBank, Piotr Arak, to share his insight regarding his thoughts about the significance of today's numbers. Hello and thank you for joining us today.
Hi, pleasure to be here.
So another setback for Hungary, minus 0.2% after it seemed that the economy was finally hitting a period of growth after 0.6% growth in the fourth quarter of 2024. The Hungarian economic decline is attributed to slowdowns in the industrial and construction sectors. What else is behind these troubles?
Well, it's the troubles of the German car manufacturing business. So it's not a new story, I would say. This is the problem that Hungary has with its over-reliance on the automotive sector.
We saw some growth. We saw some growth and now contraction.
Yeah, but it's comparing to last year. So it's this fourth quarter of last year was it viewed some optimism. Also, we saw that just some data coming from Germany on industrial production last year that we saw also optimistic about the first quarter of this year. And then everything went to hell with the tariff policy, a lack of optimism, no investments, and new contracts. So I wouldn't say that Hungary is here a very specific case. It's just a specific case of a country which is over-reliant on two major car manufacturing companies, which are over-reliant on the American market, so BMW and Mercedes-Benz.
But we see that the forecasts for this year still remain at about, between 1.9 to 2.9%. We see 2.5%, some of the forecasts for 2025, and then 4.1% for 2026. Is this in any way realistic?
I'm not as pessimistic about the Hungarian economy. So they're also having a domestic market. What they're trying to do, and this is the governmental policies of decreasing the inflation rate and decreasing the cost of living. So I'm not a big fan of the policy, but the goal is to macroeconomically make people spend more and buy, and not to increase prices. So that's why they're trying to control for the margins in 1/3 to almost half of the consumer basket, and basically decreasing statistically the inflation rate and also decreasing the cost of living for the consumer this year. Probably with the elections coming, this is something that the government is pursuing, knowing that people probably are not that happy about the economic circumstance in Hungary. So they want to have people more optimistic, want them to spend more, and use the not so small, comparing to Czech Republic and Slovakia and domestic market, in order to people buy cars, buy other stuff, so the economy would be still growing. And of course, this is connected, the downgrade in the forecast for Hungary is also connected with the downgrade of forecast for Germany. Germany was supposed to have positive growth pace. Currently, the government projects a zero pace, so zero level of growth. So the economy is going to be stagnant this year.
I was going to ask, because of the upcoming parliamentary elections, to what extent are these issues actually going to play a role?
Well, bread and butter issues is the hallmark of democracy. So this is something that any government can be topped with. So if you're not addressing the issues of the average consumer, of the average citizen, if the cost of living is increasing, if the inflation is unbearable, and Hungary still had high inflation comparing to other EU member states, specifically in Central and Eastern Europe.
It's far off the target.
Yeah, very far off the target of the central bank. So this is a cause of concern, and in no government 2023, 2024, after this inflation shock, had an easy way of getting a majority. So in France, in Poland, anywhere in the world, basically you didn't have an opportunity for the government to stick around because the inflation is something that the citizens blame the government for.
Of course. And now the Czech Republic, it seems to be doing much better in comparison after the first quarter. How does this economy differ to the Hungarian one?
Well, it's more open, it's more diversified, it has a bigger service sector than industry. And it's also doing a lot of business cross-border with Slovakia and Poland. In that sense, Czech Republic is better prepared, but it also had a worse off period before. So it's not, Czech Republic was very stagnant before. So this is a moment when the economy is kicking back with some decreases in the interest rates done by the Czech central bank last autumn and beginning of this year.
But also dependent on the German economic situation.
Yeah, but bigger economy in terms of service sector than Hungary. This is more important for them than for us. They have even a finance sector which is expanding in some circumstances. So it's something that the Hungarian government, the Hungarian economy does not lack or doesn't have.
But we also hear that the Czech economy has done better because of the household spending. And I wanted to ask you, to what extent will this allow the economy to carry on this year? Because at the end of the day, we're in a very challenging situation this year.
That's a difficult question because we don't know it's in July, probably we're going to know what the tariff policy towards Europe is from the United States. This affects all our economies. And this probably is going to be a moment when we're going to have to revise the forecast. So how big the tariffs actually are going to be? Are we going to have an agreement with the United States? If not, then what the effects of that basically are going to be. And it's difficult to make a projection not knowing this one element, which is regulatory and affects anything connected with the growth pace. Probably Czech Republic is going to perform quite well, but it's not like 3-point-something% growth pace. It's going to be lower.
But in terms of the policies that the Czechs are conducting and the Hungarians, what are the Czechs doing right that the Hungarians aren't at the moment?
Well, the reason for the growth pace, from my opinion, is that the Czech bank decided to increase interest rates earlier. They did not control for the inflation prices, so they didn't have expansionary fiscal policy throughout this year. They're more prudent on fiscal policy and also on monetary policy. They were worse off through the period of the high inflation process. So people probably were not happy. But at this circumstance, they can ease out the monetary policy right now and also can boost fiscal spending, as the Czech government, also using additional EU financing, can do. And this is something what Hungary cannot, because first off, it doesn't have access to next gen, and second off, they prolong the period of high inflation, which they still have to struggle with.
We've been talking a lot about tariffs, the international trade tensions, but the figures that we see right now, they haven't taken on board the Trump tariffs, right? So we're not fully informed as to what the impact is. Would you agree?
Yeah, because we don't know what the impact is going to be. So we cannot say. It's just, you can do an analysis of status quo, but we know that the status quo is going to change at some point.
So it could get worse, essentially.
It could get worse. It could be the same. It could be
better.
Could be better. This uncertainty is driving the markets currently. So one way or the other, it's driving the foreign exchange market as well. So whatever the American president and the administration says, negotiates, and then somebody else says that it's not happening regarding China, Russia, and the EU negotiations, then it's something pretty important. Nevertheless, the Warsaw Stock Exchange was performing quite well. It's like 2/3 of the investors on the Polish stock exchange are foreign investors. So these are the funds that keep on investing money here, and we're seeing the increases in valuations of a lot of companies. The macro data, which we're going to see for the first quarter for the Polish economy, probably are not going to be tremendously good, but a year-on-year growth pace of 3% is possible. Still very solid numbers comparing to everybody else. Consumers are spending some money. We see that in the monthly data. Investments, private investments are struggling. We're hoping for more public investments, which are going to be drivers of growth at the end of this year. And that's why probably the forecasts of about 3% growth pace, 3.2 as the IMF, or still our unrevised forecast of 3.5% growth pace this year is something that could happen. And we, comparing to Hungary and Czech Republic, probably going to be using more of the fiscal space created by Germany with its changes to the constitution and the expenditures that the new government is going to implement at the end of this year.
I just have one more question about Hungary, because Orban has a pretty good relationship with Donald Trump. Do you think that there is any space, any likelihood for economic agreements that might actually offset the impact of the tariffs?
For Hungary?
Yeah, for Hungary.
For Hungary. This is somehow surprising that what the Americans did is they did not target each country separately within the European Union. They could have done that. They could then just treat Germany and France differently. It would be a very, very difficult game for the European Union. Instead of, they played more or less by the European rules, so having a tariff for the whole European Union. Doing that, they decrease the leverage that a country with personal ties with the United States, with the current administration, has in the negotiation process. So basically, yeah, we have to rely on the European Commission and the European Union as a whole to negotiate, but then probably some of the countries can have leverage. For example, Hungary on automotive and just parts of businesses. And that's why I'm saying that there are just a handful of companies which are reliant on the Hungarian supply chain. And for them, Orban is a great lobbyist in Washington because he can then voice their concerns to the government of the United States.
Okay, so there is a chance. We have to wait and see. And in terms of all these tensions that we're experiencing, there are a lot of question marks. We don't know what's going to happen. We have to wait until the summer. But with what we know, what do you think the outlook is for Hungary and for the Czech Republic in terms of their economic growth?
Oh, well, it's probably they're going to muddle through this process. The Hungarian economy is performing a bit less good, but I agree.
Were you expecting the contraction?
No, I wouldn't say I was expecting a contraction, but probably we're going to reach a high level of the business cycle. So 2026 is going to be the high of the growth pace, very similar for Poland, and then we're going to see growth, the growth, GDP year-on-year growth decreasing in late 2026. So this is what you can see in all the midterm forecasts, if nothing else happens. So I don't know what the President of the United States has prepared for us in the near future, because then, of course, all these assumptions are going to the trash.
And just looking into the future, Polish Finance Minister Andrzej Domański remains very, very optimistic about Polish growth for 2025, 3.9%. We spoke to Katarzyna Rzętarzewska yesterday, Chief Macro Analyst for Central and Eastern Europe at Erste Group. I just wanted to play her comment regarding Polish economic growth, which is they've downgraded it to 3%.
Our forecast for Poland for this year is close to 3%, so we are slightly more kind of cautious and pessimistic than what has been mentioned by Ministry of Finance.
And I wanted to ask about what your thoughts are about Polish growth for this year. Do you take it down from the original forecasts?
Currently not, because of we also expect the additional tenders from Germany as an offside to the negative impact of tariffs. And also that we, as Poland, has a surplus with the United States in terms of trade. So it's not that we expect any direct hit for the Polish economy. What creates and decreases growth pace currently is the uncertainty. Additional investments, foreign investments that could happen in Poland. Basically, capital is waiting for what's going to happen in the negotiation process. So this is not very tangible to say how it's going to influence the Polish growth pace. But then, that being said, 3.9 was optimistic at the beginning, and I think that this was more connected with the European fiscal rules than with actual macro forecast, because nobody thought that we're going to be having a 3.9% growth pace. Currently, even the Ministry of Finance in its medium-term four-year plan adopted by the government has a 3.7 number for this year. So just for the budget to be, reaching the goals of decrease in deficit rates and debt, so it doesn't look striking, is something they probably prepared for, but the growth is going to be lower. So there's a revision decision of the budget coming probably after the holidays, somewhere in autumn, or maybe a bit earlier.
Maybe after the elections.
Maybe after the elections, probably after the elections, but it's coming sooner than later. We're not having the good numbers that the Ministry of Finance wished for when they prepared this, I would say, optimistic projection for this year and next year as well. That being said, so I think also that for next year we're a bit too optimistic.
Okay, and last but not least, next week the Polish Central Bank is probably going to take interest rates down by 50 basis points. Do you think that's going to happen? What are your thoughts?
This is what the governor Glapiński said. So, yeah, I think so. I know for certain that some of the Monetary Council members are going to propose votes on decreasing the interest rates. Most probably, the macroeconomic situation, 4.2% CPI in Poland, decreasing from 4.9, which we had in the first quarter, and increases in wages just directly in the consensus line of the market. This is a road for decreasing interest rates. So the stars are aligning for the move of the central bank. Probably one could argue that a bit late, but there is a lot of uncertainty right now. So that's why the pivot of the head of the Polish central bank made in April. But we're going to see additional ones. So this is not the last decision this year in decreasing the interest rates. The biggest question is it going to be 25 basic points or 50? More or less, people agree that it's going to be 50 basic points, but we're going to see how the outcome of the discussion, because it's not one single person making the decision, how it's going to look like, and if then it's going to be actually a cycle. So if they're going to be doing it month after month, most probably it's going to be 100 basic points to the end of this year.
Okay. Piotr Arak, Chief Economist at VeloBank, thanks so much for being with us today.
Thank you very much.
And that concludes the bottom line for today. I was your host, Marie Cato. We're on every weekday at 5:10 CET on TVP World. And in the meantime, for the latest in regional business, follow us on X and on tvpworld.com. And for more news and analysis, stay with us on TVP World. Goodbye.